Welcome to this talk ticker style deep dive. If a friend asked to borrow money from you.
Right, just out of the blue.
Yeah, but specifically to pay off the interest on a previous loan they already owed you, you would probably panic.
Oh, absolutely. That's a huge warning sign.
Exactly. And, in the financial world, that maneuver is called payment in kind, or PIK. And usually when you see a sudden, surge of PIK on a company's balance sheet, it is a giant red flag waving in the wind.
Right. It typically means a borrower is just gasping for liquidity.
Yeah.
They're essentially paying off old debt by, piling on even more debt.
Yeah. But we were just digging through the Q3 2026 earnings call transcript for Capital Southwest, ticker symbol CSWC. And we noticed a massive $1.8 million surge in this exact type of debt-paying debt arrangement.
And yet, management framed it as their biggest signal of underlying strength, which is wild.
Right. So we are going to look closely at exactly how they pulled off that paradox, along with some brilliant financial engineering involving a new joint venture, plus what it all means for your portfolio. So, okay, let's unpack this.
Yeah, that PIK paradox is really the key to unlocking how this specific management team operates.
Yeah.
This quarter really is a masterclass in how a lending company thrives, even when interest rates and market conditions get super choppy.
Definitely. And to set the stage for you, Capital Southwest operates in this very specific niche, right? They are a business development company, or a BDC,
right?
And they provide debt and sometimes equity capital to the lower middle market.
Which is everyday businesses that generate between $3 million and $15 million in EBITDA.
Yeah, which is just a fancy way of saying their core cash flow before the accountants get involved.
Exactly. We are not talking about glamorous tech startups trying to build artificial intelligence models in Silicon Valley here.
No, not at all. These are regional plumbing distributors, specialized logistics firms, niche manufacturing plants.
Local healthcare providers.
Right. They are the invisible gears grinding away in the background of the broader economy.
And honestly, the boring nature of these businesses is entirely the point. When you are lending money, boredom is your best friend.
It really is.
I mean, a company making specialized cardboard boxes for shipping might not make the front page of the financial papers, but it generates highly predictable, sticky revenue. And that is exactly what a lender needs to secure a steady stream of interest payments.
Right. And over the past decade, traditional regional banks have largely retreated from lending to these types of companies, mostly due to increased regulatory burden.
Yeah, and capital requirements. Mm-hmm. That retreat created a massive vacuum. So private credit firms and BDCs like Capital Southwest stepped into that void, becoming the primary source of growth capital for, the backbone of the American economy.
And the numbers they just reported show that they are extracting a massive amount of value from that backbone. Let's get right into the headline data from this Q3 transcript, because the metrics came in incredibly hot.
Extremely hot.
Their pre-tax net investment income, which is the core operating profitability metric for a BDC, it hit 60 cents per share.
That's solid.
Yeah. And total investment income saw a really solid sequential jump, landing at $61.4 million.
Which is a huge move up from the $56.9 million they reported just one quarter prior.
Right. When you see top-line revenue jumping by millions of dollars quarter over quarter in a lending business, it means the engine is firing on all cylinders.
That sequential growth is such a critical indicator. In a lending portfolio, standing still essentially means you are moving backward. Right? Loans are constantly being paid off or refinanced.
Yeah, you have to keep replacing them.
Exactly. So if your total investment income is growing from $56.9 million to $61.4 million, it means you are not only originating enough new high-quality loans to replace the ones rolling off the books,
but you are actually expanding the earning power of the total asset base.
Right. You are successfully deploying new capital into the market at attractive yields.
Which brings us to the bedrock metric of this entire space, net asset value, or NAV. Capital Southwest reported that their NAV increased to $16.75 per share, up from $16.62 the previous quarter.
Yeah.
Now, I know we throw the term NAV around a lot, but for someone managing their own retail portfolio, it's worth unpacking exactly why this number dictates everything in the BDC universe.
Sure. So think of net asset value as the absolute liquidation reality of the company. It's the book value.
Okay, so if they shut down tomorrow.
Exactly. If Capital Southwest decided tomorrow to close its doors, call in every single loan it has made, sell off all of its equity stakes, pay off all of its corporate debt, and then distribute whatever cash was left over directly into your brokerage account, that final payout is the NAV.
Wow, okay.
It represents what the underlying portfolio of loans and investments is actually worth on a per-share basis, completely stripped of market sentiment or stock price momentum. It's the tangible book value of the house.
Which makes that increase from 1662 to 1675 incredibly important. I mean, they aren't just paying out big dividends by cannibalizing the foundation of the house. The foundation itself is getting thicker.
And that is the ultimate test of a healthy dividend yield. A lot of retail investors get lured into buying specialized high-yield stocks purely because they see an enormous dividend percentage on their stock screener.
Oh, all the time. Yield chasing.
Right. But if the company is paying that massive dividend while their net asset value is steadily dropping quarter after quarter, it means they are effectively returning your own principal back to you and calling it a yield.
Which is a destructive loop.
Exactly. When a BDC can pay a massive dividend while simultaneously growing its net asset value, it means the dividend is being funded purely by the organic cash flow generated by the portfolio.
And the underlying assets are actually appreciating. And speaking of that dividend, let's look at the actual payout they announced, because it is extremely attractive.
It really is.
They declared a 58-cent regular quarterly dividend plus an additional 6-cent supplemental dividend.
So you are looking at a total payout of 64 cents per share just for the March quarter.
Yeah. But the raw dollar amount isn't even the most impressive part of the announcement. Management spent a significant portion of the call highlighting their dividend coverage ratio, which is currently sitting at a staggering 110%.
That coverage ratio is the ultimate sleep at night metric.
Right.
A 110% coverage ratio means that for every single dollar Capital Southwest is paying out to you in that 64-cent dividend, the portfolio is actually generating $1.10 in hard cash earnings.
They are out-earning their own distribution by a wide margin.
Exactly. In the credit markets, where unexpected defaults or sudden shifts in interest rates can temporarily disrupt cash flows, having a 10% buffer built directly into your core earnings profile provides massive structural safety.
Which begs the question, right? If they are out-earning their dividend by 10%, where exactly does that excess cash go? It doesn't just vanish into the ether.
No, it doesn't.
And this is where we get into one of those powerful structural advantages in their transcript. That excess cash flows directly into a reservoir called undistributed taxable income, or UTI. And the balance of that reservoir right now is just mind-boggling. Capital Southwest reported a UTI balance of $1.02 per share.
Yeah, to understand the magnitude of that $1.02 per share, we have to look at the tax structure of a business development company.
Okay.
By law, a BDC is structured as a regulated investment company. That special status means they do not pay corporate income tax, which is a massive advantage over a traditional corporation.
Right. But there's a catch.
There is. To maintain that tax-free status, the IRS requires them to distribute at least 90% of their taxable income to shareholders every single year.
So they basically have to pay it out.
Yes, but they do not have to distribute 100%. They are allowed to hold back that final 10%, pay a small excise tax on it, and keep it on the balance sheet.
Oh, I see.
So over time, quarter after quarter of out-earning their dividend, that retained cash piles up into the UTI bucket.
So having $1.02 per share sitting in UTI means they have essentially stockpiled more than a full year's worth of those 6-cent supplemental dividends. It's like a massive financial shock absorber.
It completely changes the risk profile for the dividend investor. We know the credit markets are cyclical. There will inevitably be quarters where the economy contracts, a few borrowers stumble, and core earnings might temporarily dip.
Right. And for a normal company, that immediately triggers a dividend cut, which usually causes the stock price to plummet.
Exactly. But with a $1.02 UTI cushion, Capital Southwest could face a severe prolonged earnings shortfall and still smoothly maintain their 64-cent total payout by simply drawing down from the reservoir.
It effectively insulates the shareholders' income stream from short-term macroeconomic volatility. That's huge.
It really is.
So you just mentioned they have a massive $1.02 per share in reserve. That begs the question, what actually drove the revenue beat? Like, in a competitive lending economy, how on earth are they generating enough excess cash to fill that bucket so aggressively?
Well, if we look under the hood of these revenue numbers, the transcript isolates a few specific drivers that push that total investment income up to $61.4 million.
Yeah, the CEO, Michael Cerner, and the CFO, Chris Rehberger, pointed to a $1.1 million increase in fees, a $1 million increase in dividend income from their portfolio companies.
And most notably, a $1.8 million increase in PIK income.
Right. And this is where the transcript moves from simple accounting into high-level corporate strategy. We have to address that $1.8 million surge in payment in kind, or PIK income. Because as we established earlier, PIK is traditionally the canary in the coal mine for a stressed lending portfolio. Just for anyone not deeply embedded in private credit, payment in kind means the borrower cannot or chooses not to pay their interest obligation in cash.
Right.
Instead, the lender agrees to just add the owed interest onto the total principal balance of the loan.
They pay their debt with more debt.
Exactly.
Yeah.
It looks great on an income statement because the lender gets to book the revenue, but no actual cash changed hands. So my immediate reaction when I read a $1.8 million jump in PIK was to assume, wait, is this just funny money?
Yeah.
Like, is one of their major portfolio companies suffocating? They can't make payroll, and Capital Southwest is just papering over a bad loan to avoid reporting a default.
And that is exactly the critical lens you should apply to any BDC earnings report. A sudden, unexplained spike in PIK income usually indicates that the lender's playing extend and pretend with a failing business.
Right.
But what's fascinating here is that the context provided by the CFO on this call completely flips that traditional narrative on its head. Well, he explicitly detailed the mechanics behind this specific $1.8 million increase. And it is a fascinating look into the power dynamics between lenders and private equity sponsors.
Yeah, let's break down exactly what happened, because it turns out this wasn't a borrower gasping for air. It was a strategic restructuring.
The CFO explained that this PIK increase was driven by an amendment to a loan with one specific portfolio company. The private equity firm that owns this company, the sponsor, approached Capital Southwest.
Okay.
They wanted the flexibility to pay a portion of their future interest in kind rather than in cash, presumably to keep more liquid capital inside the business for growth or operational flexibility.
But normally a lender would flatly reject that request. Like, why would you willingly give up cash flow?
Unless you extract a massive concession in return. Precisely the mechanic at play here.
Well.
In exchange for granting this PIK option, Capital Southwest forced the private equity sponsor to inject significant new cold hard cash equity into the business. And they required a portion of that new cash to be used immediately to pay down a chunk of the principal debt owed to Capital Southwest.
Okay, so the sponsor essentially bought the right to use PIK. They wrote a massive check from their own fund, handed it to the portfolio company, and used it to instantly de-risk Capital Southwest's position by lowering the total outstanding loan balance.
When you view it through that lens, it is an incredible signal of strength. Private equity firms are notoriously ruthless with their capital. They do not throw good money after bad.
Right.
If a portfolio company is truly failing and cannot be saved, the sponsor will simply write the investment down to zero, walk away, and hand the keys to the lender.
They just wash their hands of it.
Exactly. So the fact that this specific sponsor was willing to reach into their pocket and inject significant new cash equity into this business tells you two things.
What are they?
First, they deeply believe in the long-term enterprise value of the company. They are willing to double down. And second, the loan on Capital Southwest's books is now backed by a fundamentally stronger, better capitalized company with a lower absolute debt burden.
That is such a vital distinction. It completely recontextualizes the data. It transforms a $1.8 million accounting line item from a potential default warning into proof of a rock-solid relationship with a well-capitalized sponsor.
Right.
It's a prime example of why you can't just run a stock screener on BDCs, You actually have to read the transcripts to understand the quality of the revenue.
And that concept of revenue quality extends beyond just the interest payments. If we look at the other major driver of their excess capital, we have to talk about their equity co-investments.
Oh, definitely.
The CEO highlighted on the call that they have harvested a staggering $44.5 million in realized gains from equity exits over the trailing 12 months.
This is a fascinating aspect of their business model. When we talk about business development companies, we usually just picture a traditional bank. They write a loan, they collect 8% or 10% interest, and they eventually get their principal back.
A fixed income strategy, basically.
Right. But Capital Southwest operates with a dual engine. The transcript notes that 9.1% of their entire portfolio is actually invested in equity. They own minority stakes in these lower middle market companies right alongside the private equity sponsors.
And this is a structural advantage unique to the lower middle market. When a private equity firm buys a $10 million EBITDA company, they need debt to finance the buyout.
Yeah.
Because Capital Southwest is providing that critical, customized debt capital, they often demand the right to invest in the equity upside as well. They essentially tell the sponsor, we will give you the loan, but we also want the option to buy 2% or 5% of the company's equity at the same valuation you're paying.
So they are essentially riding the sponsor's coattails. The private equity firm does all the heavy lifting. They restructure the management. They drive operational efficiencies. They acquire smaller competitors to roll up the industry.
Right.
And Capital Southwest just gets to sit back, collect their steady interest payments on the debt, and watch the value of their minority equity ticket quietly multiply in the background.
And the math on those equity tickets is explosive. The transcript reveals that their current active equity portfolio is marked at 133% of its original cost.
Wow.
Yeah, that represents over $45 million in embedded, unrealized depreciation just sitting on their balance sheet right now.
That's incredible.
When one of these portfolio companies is eventually sold to a larger competitor or a mega cap private equity fund, Capital Southwest's loan gets paid off at par, but their equity stake gets cashed out at a massive premium.
So that $44.5 million in realized gains they harvested over the last year is pure, unadulterated profit. It is the primary engine constantly refilling that massive $1.02 per share UTI bucket we discussed earlier.
It's the perfect barbell strategy. The debt portfolio provides the steady 110% dividend coverage for the quarterly payout, while the equity portfolio provides the massive, lumpy cash windfalls that fund the supplemental dividends and protect the NAV.
But none of that matters if the core loans blow up.
Very true.
You can have all the equity upside in the world, but if your borrowers start defaulting on their debt en masse, the whole structure collapses. Management clearly understood this because they spent a vast amount of time on this call defending their underwriting safety and walking analysts through their risk management metrics.
The risk metrics they detailed are highly reassuring, particularly if we are heading into a period of prolonged macroeconomic uncertainty. The chief investment officer, Josh Weinstein, laid out their positioning within the capital stack, and it is aggressively conservative. He noted that 100% of their new debt originations this quarter were first lien senior secured.
Okay, 100%.
And looking at the legacy portfolio as a whole, an overwhelming 99% of their debt sits in that exact same first lien senior secured position.
So for the lay investor, the term capital stack refers to the strict legal hierarchy of who gets paid back if a company goes bankrupt. When a business hits the wall and liquidates, there is a literal line out the door of people holding their hands out.
Right, and the equity owners are at the very back of the line. They usually get wiped out entirely.
Yeah, then you have unsecured creditors, mezzanine debt, and second lien lenders. Being first lien senior secured means Capital Southwest is standing at the absolute front of that line. Their loans are legally secured by the physical and intellectual assets of the borrowing company. If the plumbing distributor goes bankrupt, Capital Southwest has the right to seize the warehouses, the inventory, the trucks, and the customer contracts, sell them off, and recover their principal before anyone else in the capital stack sees a single dime.
It is the safest possible posture a commercial lender can take. You are sacrificing some absolute yield to ensure maximum principal protection. But they don't just rely on the legal structure of the loan. They rely on extreme diversification.
Okay, how so?
The transcript outlines that they have 132 different portfolio companies spread across various industries. More importantly, their average exposure to any single company is less than 1% of their total portfolio.
Oh, wow. That granularity is crucial. If you lend 20% of your total assets to one massive company and that company mismanages its cash flow, your entire dividend is instantly threatened. But when your average position size is under 1%, even a complete worst-case catastrophic failure of a single business is just a flesh wound to the overall portfolio.
They are structurally isolating idiosyncratic risk. If one specific management team at a portfolio company makes a fatal strategic error or a localized natural disaster destroys a key facility, the damage is ring-fenced to that tiny sub 1% sliver of Capital Southwest's balance sheet.
Right.
The broader 99% of the portfolio continues to generate the cash needed to cover the dividend. And the empirical proof that this conservative, granular underwriting model is actually working is found in their non-accrual rate.
Right. Non-accruals are the actual bad loans. These are the companies that have stopped paying their interest, forcing Capital Southwest to stop recognizing the revenue. As of this Q3 report, their non-accruals represented just 1.5% of their total investment portfolio at fair value.
In the context of lower middle market lending, where you are dealing with smaller companies that naturally have less margin for error than a Fortune 500 corporation, maintaining a 1.5% default rate over a trailing 12-month period is microscopic.
It really is.
It is a testament to incredibly tight credit discipline at the origination level. They are simply not letting bad companies into the portfolio to begin with.
And their absolute biggest defense against default is the amount of skin the private equity sponsors have in the game. The chief investment officer noted a statistic that I think is the most important risk metric in the entire transcript.
Okay.
He stated that across their portfolio, their loans represent, on average, only 44% of the underlying company's enterprise value.
Yeah, that 44% loan to value, or LTV, ratio is the ultimate margin of safety. Let's visualize what that actually means.
Okay.
If a private equity sponsor buys a business for $100 million, a 44% LTV means Capital Southwest is only providing $44 million in debt. The sponsor and the management team are putting up the remaining $56 million in pure cash equity.
So the enterprise value of that business would literally have to plummet from $100 million down to $43 million, which is a catastrophic 57% destruction of value before Capital Southwest's debt principal is even theoretically impaired.
Right.
The private equity firm would have to lose their entire $56 million investment before Capital Southwest loses a single dollar.
And remember, private equity sponsors are fiercely protective of their capital. If a company's value starts sliding from $100 million down to $80 million, the sponsor isn't just going to sit there and watch it burn.
No, they're going to act.
They will fire the CEO, inject more capital, restructure operations, or sell off non-core divisions to protect their equity. And all of those defensive actions inherently protect Capital Southwest's debt position at the bottom of the stack. A 44% average LTV ensures that the incentives of the borrower are perfectly aligned with the safety of the lender.
So we have spent a lot of time dissecting how well they are managing the past and the present, but here's where it gets really interesting. The back half of this earnings call was completely dedicated to management guidance and how they are navigating a rapidly shifting future.
Right.
Because the macroeconomic environment for lenders is changing, and the centerpiece of this entire Q3 report was the announcement of a massive new strategic vehicle, a joint venture, or JV, with a prominent private credit asset manager.
This joint venture announcement is arguably the most consequential strategic pivot they have made in years.
Oh, absolutely.
To fully grasp why they are launching this vehicle right now, you have to understand the specific pressure cooking the broader credit markets. During the Q&A portion of the call, several analysts pressed management on the competitive dynamic in the lower middle market and the outlook for spreads.
Right, and a spread is essentially the profit margin for a lender. It is the mathematical difference between the interest rate a lender charges their borrower and the underlying base rate in the economy, like the SOFR rate.
Yes.
If the base rate is 5% and you charge the borrower 10%, your spread is 5%. It's the premium you earn for taking on the credit risk.
And the CEO, Michael Sarner, was very candid about the reality of those spreads. He admitted that while the competitive environment hasn't deteriorated drastically in the last 6 months, there has been a steady, undeniable spread compression across the industry over the last 12 to 18 months.
Which is tough.
Yeah, he noted that their overall portfolio yield on debt has ticked down from 7.35% to 7.24%. And more troublingly, new high-quality loans are currently being originated with spreads compressing into the mid-6% range.
It's a classic supply and demand problem. The lower middle market has performed so well with such low default rates that massive amounts of institutional capital have flooded into the space. Mega funds and asset managers are launching their own private credit vehicles.
So they're all competing for the same deals.
Exactly. So you have more lenders chasing the exact same pool of high-quality borrowers. When 5 lenders show up to bid on financing a rock-solid, incredibly safe $10 million EBITDA company, the private equity sponsor simply plays them off each other to drive the interest rate down.
Exactly. The absolute safest borrowers in the market, the companies with flawless cash flow and massive equity cushions, are now commanding incredibly tight spreads. Management noted that top-tier sleep-at-night credit deals are now clearing the market at spreads as low as 5% to 5.75%.
And historically, that dynamic created a structural trap for Capital Southwest. They had an internal hurdle rate where they essentially had to draw a line in the sand at a 5.75% spread.
Right.
If a loan yielded less than that, they had to walk away because a 5% yield simply doesn't generate enough return on equity to support their massive 64-cent quarterly dividend payout to their retail shareholders.
It creates a dangerous temptation for a BDC. When the safest loans yield too little to cover the dividend, a lazy management team will simply start drifting down the credit quality spectrum.
Yeah, chasing yield.
They will start lending to slightly riskier, highly leveraged companies purely to capture a 7% or 8% spread to keep the dividend math working. Over time, that degrades the portfolio quality and leads to massive defaults in a recession.
But Capital Southwest refused to lower their underwriting standards. They didn't want to take on riskier borrowers. They wanted to lend to the absolute safest companies in the market, but they needed a way to make the math work.
And enter the new joint venture.
Yes. I want to break down exactly how this JV structurally manipulates a low-yielding, ultra-safe loan into a high-yielding dividend engine, because the financial engineering here is just brilliant.
It really is. Think of this JV loan structure like a highly customized, layered cake. I'll use the exact numerical example the CEO provided on the call to illustrate the mechanics. Let's imagine there is an incredibly pristine, safe borrower with $10 million in EBITDA.
Okay.
They need a $35 million loan. Because the company is so safe, the market prices the loan very conservatively at a 5.5% overall spread. As we established, a 5.5% spread is normally too low for Capital Southwest to hold on their balance sheet.
Right. So instead of funding the whole $35 million themselves, they bring the loan into the joint venture and they slice the cake horizontally.
Exactly. They split the $35 million loan into 2 distinct tranches. The joint venture partner, the outside asset manager who has a much lower cost of capital and different return requirements, takes $10 million of the loan in what is called a first-out position.
Which is the bottom layer of the cake.
Right. It assumes the absolute lowest risk. If the borrower defaults, that $10 million gets paid back before a single other dollar moves. Because the JV partner is getting this extreme ironclad safety, they agree to accept a much lower yield. They only take a 3.75% spread on their $10 million chunk.
Okay, so the JV partner gets maximum security in exchange for a meager 3.75% return. But the borrower is still paying 5.5% on the total $35 million.
Right.
That means there is a significant amount of excess yield floating around.
And that is where Capital Southwest steps in. They hold the remaining $25 million of the loan on their own balance sheet in a last-out position. This is the top layer of the cake.
Okay.
They are technically second in line behind the JV partner if a default occurs, meaning they take slightly more structural risk. However, because the underlying borrower is inherently a top-tier, ultra-safe company to begin with, the absolute risk of default remains incredibly low.
Oh, I see.
So in exchange for taking that top layer position, Capital Southwest gets to scrape all of the leftover excess yield generated by the overall 5.5% loan.
They absorb the spread differential. By mathematically shifting the yield away from the JV partner's tranche, Capital Southwest artificially boosts the spread on their $25 million chunk from the baseline 5.5% all the way up to 6.25%.
It is pure arbitrage.
Yeah.
They are manipulating the capital structure to manufacture a higher yield on the exact same underlying corporate credit risk.
Yeah.
And the brilliance of the strategy doesn't stop there. Because Capital Southwest acts as the originator of the loan, handles all the underwriting, and serves as the administrative agent for the entire joint venture, they extract additional fees.
Of course they do.
They charge the JV partner arranger fees up front, and they collect ongoing management fees for servicing the loan.
So when you combine that artificially boosted 6.25% spread on their last out tranche with the constant stream of management fees they are siphoning off their partner, the economics transform completely.
Oh, yeah.
The CEO stated that once this joint venture is fully ramped up and operating at scale, the capital they invest in it will generate a low to mid-teens equity return.
They have solved the spread compression puzzle. They can now actively, aggressively bid on the safest, lowest yielding 5% loans in the lower middle market, the true sleep at night credit. Run it through the JV machinery and spin out a double-digit return on equity to fund your 64-cent dividend.
Which is amazing.
It allows them to simultaneously increase the overall credit quality of the portfolio while maintaining massive dividend coverage.
It is a masterclass in capital allocation. But the joint venture wasn't the only major financial flex discussed in the guidance section of the call. We also have to talk about how they are funding their balance sheet because they are utilizing a structural advantage that very few other lending platforms possess.
Right.
The CFO noted that during the quarter, they aggressively utilized their ATM, or at the market, equity issuance program. They raised roughly $53 million in gross equity proceeds by selling brand new shares of Capital Southwest directly into the public market.
In almost any other sector of the stock market, an announcement that a company is issuing $53 million in new shares triggers an immediate sell-off.
Oh yeah, people hate that.
Retail investors instinctively view share issuance as hostile dilution. You are increasing the total slice of the pie, making everyone's existing slice smaller. But in the specialized world of business development companies, issuing equity can actually be a massive catalyst for growth.
Provided you look at one critical metric, right? The issuance price relative to the net asset value. And this is where the flywheel effect of a premium valuation comes into play. The transcript details that Capital Southwest sold these new shares at a weighted average price of $21.11 per share. Now, if we remember from our breakdown of the headline numbers earlier, the actual net asset value, the mathematically calculated underlying worth of their loan portfolio, is only $16.75 per share.
The market is assigning a massive premium to the stock. They are literally minting new shares representing $16.75 worth of actual assets and selling them to willing public market investors for $21.11.
That's incredible.
They are issuing equity at an astonishing 127% of their net asset value.
Explain exactly why that specific math is so accretive to the existing retail shareholder. Like, why does selling $1 for $1.27 actually benefit the person who already owns the stock?
It functions as an immediate, mathematically guaranteed boost to the underlying value of the company. Imagine you and I own a company that holds two $10 bills. The company is worth $20, and we each own one share worth $10.
Right.
Now, an outside investor comes along and desperately wants into our company. They offer to buy a newly issued third share, but they are willing to pay $16 for it. The company now holds our original $20 plus the new investor's $16.
Okay, so $36 total.
Exactly. The company has $36 in total cash divided by 3 shares. Suddenly, the intrinsic value of every single share, including yours and mine, has instantly mathematically increased from $10 to $12.
Wow.
By selling new shares at a premium to the existing asset value, Capital Southwest is literally pulling free value out of the market and permanently embedding it into their NAV.
It creates a self-fulfilling prophecy of success. Because they have a pristine underwriting record, the market rewards them with a high stock price. Because they have a high stock price, their cost of equity capital is incredibly cheap.
Right.
They can raise millions of dollars at a premium, which instantly grows the NAV, which makes the company structurally safer, which in turn justifies an even higher stock price.
It is the most powerful competitive advantage a BDC can possess. While their competitors who trade below NAV are essentially paralyzed, unable to raise new equity without severely diluting their shareholders, Capital Southwest has a printing press of highly accretive, low-cost capital.
And I notice in the transcript that they aren't just sitting on that $53 million in premium equity capital either. They didn't just throw it in a bank account.
No, they didn't.
They immediately weaponized it to optimize their liability structure.
Yeah.
The CFO detailed how they took the proceeds from this ATM equity issuance, combined it with a brand new $350 million institutional bond offering priced at 5.95%, and used that massive pool of capital to completely redeem and pay off older, more expensive corporate debt that was coming due in 2026 and 2028.
Yeah.
It looks like they are intentionally clearing the deck and building a maturity wall further out into the 2030s.
That is exactly what they are doing. And it is a textbook defensive maneuver against interest rate volatility.
Okay.
In commercial lending, your biggest existential threat isn't always loan defaults. It is a liquidity crisis. If you have hundreds of millions of dollars in corporate debt coming due in the next 18 months, and the credit markets suddenly freeze or interest rates spike dramatically, you might not be able to refinance that debt.
Which is terrifying.
You could be forced into a fire sale of your underlying assets just to meet your obligations.
But by proactively paying off their 2026 and 2028 notes today, Capital Southwest has effectively pushed their debt maturity horizon completely out of sight. They don't have any significant corporate debt coming due until the end of the decade.
Right.
They've insulated the balance sheet from any short-term credit market shocks.
And they achieve this while maintaining an incredibly efficient cost of leverage. They noted on the call that they have now reached $4.4 billion in total fixed-rate debt capacity.
Wow, that's a lot.
This is a critical structural nuance. The loans Capital Southwest makes to their portfolio companies are almost entirely floating rate, meaning if the Federal Reserve raises interest rates, the borrowers have to pay Capital Southwest more interest immediately.
Right.
But the debt Capital Southwest borrows to fund themselves is heavily fixed rate. They've locked in their own borrowing costs long term, while their income stream floats with the market. It ensures their profit spreads are protected regardless of which direction the macroeconomic winds blow.
So we have dissected the revenue beats, the structural safety of the portfolio, the brilliant financial engineering of the joint venture, and the power of their premium equity valuation. This brings us to the ultimate bottom line.
Okay.
Our goal is to synthesize all of this complex data and give you an actionable, opinionated verdict on what this transcript actually means for your investment thesis. And based on a thorough analysis of their Q3 report, our stance on Capital Southwest is highly, emphatically bullish.
I agree. The empirical evidence in the transcript points to a management team operating at the absolute peak of their sector.
Yeah.
They are not coasting on macro tailwinds. They are actively engineering value.
Yeah.
The conservative 44% average loan-to-value ratio ensures the portfolio is insulated against significant principal loss, even if the broader economy enters a recession. Their microscopic 1.5% non-accrual rate proves their credit underwriting process is rigorous and disciplined.
And the strategic deployment of the joint venture demonstrates their ability to creatively manufacture double-digit yields from 5% loans without taking on excessive risk.
Exactly.
So for the retail investor, the actionable takeaway here is twofold, depending on your current position. First, if you already hold Capital Southwest stock in your portfolio, the data strongly suggests you can sit back and comfortably collect your quarterly checks.
Right.
That total 64-cent dividend is wrapped in layers of structural armor. It is protected by the 110% core operating coverage. It is backstopped by the massive $1.02 per share in undistributed taxable income. And it is continuously fueled by the ongoing realization of their $45 million in embedded equity gains. Your income stream is highly secure.
The calculus is slightly more nuanced if you're looking to initiate a new position today, though. You have to acknowledge the reality of the public market pricing. Capital Southwest is an expensive stock.
Yeah, that's true.
It is currently trading well above its $16.75 net asset value. Value investors who screen purely for discounts to book value will instinctively balk at paying a 30% or 40% premium.
But as the CEO astutely noted during the call in the business development company sector, a premium valuation is a feature, not a bug. You generally get exactly what you pay for.
Oh, absolutely.
You can easily find BDCs trading at a 20% discount to their NAV, paying a 14% dividend yield. But when you look under the hood, you will usually find a portfolio riddled with defaulting loans, highly leveraged borrowers, and a management team trapped by a high cost of capital.
Right.
A company executing flawlessly with a pristine balance sheet and the ability to accretively raise equity deserves a premium multiple. You are paying top dollar, but you are buying absolute operational certainty in an uncertain market.
It comes down to your risk tolerance. You're paying a premium to essentially outsource your credit underwriting to a management team that is proven, cycle after cycle, that they can navigate complex credit environments while protecting shareholder principal.
As we wrap up this deep dive, we always like to look over the horizon. We've spent this entire time analyzing the traditional risks a lender worries about: interest rate spreads, default metrics, and loan-to-value ratios.
The standard variables of commercial credit.
Yeah. But there was a fascinating exchange during the analyst Q&A at the very end of the call that introduced a completely modern, almost existential variable into the conversation.
This raises an important question, actually. An analyst asked a very forward-looking question about technological disruption. Specifically, they asked how Capital Southwest is evaluating the risk of artificial intelligence impacting their portfolio companies.
Oh, wow.
And the CEO's response was incredibly candid and revealing about their long-term strategic thinking. He noted that they aren't just reacting to AI headlines. They have structurally integrated it into their underwriting. About a year ago, they formed a dedicated internal AI committee.
Wait, really? He explicitly stated that AI risk assessment is now a mandatory part of the investment committee process for every single new loan they evaluate?
Yes. And he gave a specific, chilling example of how this plays out in real time. They were recently evaluating a loan for a potential new borrower. Looking at the company's financials today, it was perfectly healthy. The cash flow was strong, the margins were solid.
Okay, sounds good.
But as the AI committee analyzed the business model, they realized that while the company would be fine for the next 24 months, its core service could be severely disrupted or completely automated away by AI in a 5-year time frame.
This is a profound evolution in credit risk management. For decades, the fundamental thesis of lending to the lower middle market has been stability. These are supposed to be the boring, unglamorous businesses, regional logistics, specialized B2B services, niche distributors that are completely insulated from the wild technological swings of Silicon Valley.
Right, you lend to them precisely because their business models haven't changed in 30 years.
But Capital Southwest is already modeling a future where that assumed safety is an illusion. The algorithm isn't coming for the local plumber who physically fixes the pipes, but it might absolutely obliterate the regional plumbing distributor whose entire business model relies on manual supply chain management, localized inventory routing, and traditional customer service logistics.
Exactly. If an AI agent can optimize that entire distribution network instantly and flawlessly, the middleman distributor goes bankrupt.
And if that business model is rendered obsolete in 5 years, the terminal value of the company collapses to zero. They won't be able to refinance their debt or sell the business when the principal comes due. Capital Southwest recognized this terminal risk and literally walked away from the deal.
They turned down a healthy loan today because they couldn't confidently underwrite the company's relevance 5 years from now.
It's a fascinating, provocative variable that every long-term investor in the private credit space needs to start factoring into their thesis. It's no longer just about whether a borrower has enough cash to pay their interest next quarter. It's about whether the fundamental economic purpose of that business will even exist in a recognizable form when the loan matures.
Yeah, Capital Southwest is actively playing that three-dimensional chess, ensuring their portfolio isn't just financially secure, but technologically resilient.
Thank you for joining us on this expansive deep dive into the underlying mechanics, the strategic financial engineering, and the technological foresight of Capital Southwest. We unpacked the jargon, we pressure tested the data, and we hope you walk away with a much clearer, actionable understanding of what this earnings call means for your capital. We will catch you on the next deep dive.